I've been managing money for over 7 decades now, and I can tell you something that might surprise you. The portfolio I'm holding today in 2026 looks very different from what most people would expect. Not because I've changed my philosophy, but because the world has changed around us, and I've simply stuck to the same principles that have worked since I was a boy in Omaha buying my first stock at age 11. Let me tell you about those 12 positions I'm holding right now, and more importantly, why I'm holding them. But before I get into the specifics, I want to share a story that explains everything about how I think about investing. Back in 1951, I read a book that changed my life. It was The Intelligent Investor by Ben Graham. And there was one chapter, chapter 8, about Mr. Market. Ben described the stock market as a business partner who shows up every day offering to buy your share of the business or sell you his share some days. He's wildly optimistic and offers you a high price. Other days, he's deeply pessimistic and offers you a low price. The key insight was this: you don't have to accept his offers. You can ignore him completely. You only do business with him when it suits you. That simple concept has guided every investment decision I've made since then, and it's guided the construction of this portfolio you're about to hear about. Now, when people ask me about my portfolio, they often expect some complicated strategy, some secret formula. But the truth is embarrassingly simple. I look for wonderful businesses at fair prices, businesses I can understand, businesses with durable competitive advantages, businesses run by people I trust, and then I hold them for a very long time. Let me start with my largest position, because it tells you everything about how I think. Apple represents about 40% of my equity portfolio right now, and I can already hear the critics saying that's too concentrated, too risky. But let me explain why I sleep well at night with this position. I bought my first shares of Apple back in 2016, and people thought I'd lost my mind. Here was Warren Buffett, the guy who famously avoided technology stocks, suddenly buying billions of dollars worth of a company that makes phones and computers. But what those critics missed was what I saw in Apple. Apple isn't a technology company to me. It's a consumer products company with an incredible brand and an ecosystem that creates what I call a moat. When I think about moats, I'm thinking about competitive advantages that protect the business from competition. Apple's moat is one of the strongest I've ever seen. Think about it this way. If you own an iPhone, you probably own an Apple Watch, maybe AirPods, maybe an iPad, maybe a MacBook. And all of these devices work together seamlessly. Your photos sync across all your devices. Your messages appear everywhere. Your apps and subscriptions follow you from device to device. The cost of switching to a competitor isn't just the price of a new phone. It's the disruption to your entire digital life. That's a powerful moat. And it's reflected in Apple's pricing power. They can charge premium prices and people pay them happily because the value is there. But there's another aspect of Apple that really attracts me, and that's the capital allocation. Tim Cook has done a masterful job of returning cash to shareholders through dividends and buybacks. Over the past decade, Apple has reduced its share count by more than 40% through buybacks. That means my ownership stake in the company grows every year without me doing anything. Some people criticize buybacks as financial engineering, but I see them as the most tax-efficient way for a company to return capital when the stock is trading at a reasonable price. And Apple has been buying back stock intelligently, not just mechanically. The dividends are growing too, not dramatically, but steadily. Apple yields around 0.5%, which doesn't sound like much until you realize that on my cost basis from 2016, I'm now earning over 5% annually in dividends. And that yield on cost keeps growing every year as they raise the dividend. Now, let me address the elephant in the room. Is Apple's best growth behind it? Almost certainly. The company generated almost $400 billion in revenue last year. You can't grow at 20% per year when you're that large. But you know what? I don't need 20% growth. I need predictable, durable earnings and cash flow. And Apple delivers that in abundance. The services business is particularly attractive. When you look at Apple's revenue breakdown, about a quarter now comes from services. The App Store, Apple Music, iCloud, Apple Pay, and all the rest. These are high-margin, recurring revenue streams that grow steadily and create deeper customer lock-in. I'm holding Apple for the long term, and I expect it will remain my largest position for years to come. My second largest holding is Bank of America, and this one represents about 15% of my portfolio. I've known Brian Moynihan, the CEO, for many years, and I have tremendous respect for how he's run the bank. Banking is a business I understand deeply. I've been involved in banking and insurance since the 1960s, and Bank of America has several characteristics that make it attractive. First, they have massive scale. They're one of the 4 largest banks in America with enormous distribution through branches and digital channels. Scale matters in banking because it allows you to spread fixed costs over a huge base and invest in technology that smaller banks can't afford. Second, they're well capitalized and well managed. After the financial crisis, Bank of America had to rebuild itself from the ground up. They sold off non-core businesses, strengthened their balance sheet, and focused on their core franchises: consumer banking, wealth management, and corporate banking. The bank that emerged from that process is much stronger than before. Third, I like their position as interest rates have been adjusting. Banks make money on the spread between what they pay for deposits and what they earn on loans. When rates were near zero for over a decade, that compressed bank earnings. As rates normalized, Bank of America benefited significantly because they have a large base of deposits that don't pay much interest, but they can invest in higher yielding assets. Now, I know banking has risks. Banks are leveraged institutions and financial crises happen. But Bank of America is too important to the American financial system to be allowed to fail. That might sound like I'm betting on bailouts, but I'm really betting on prudent regulation and conservative management, and I've seen both at Bank of America. The stock also trades at a reasonable valuation, usually around book value or slightly above. For a franchise of this quality with decent growth prospects and a solid dividend, that strikes me as fair. My third position is American Express, which makes up about 10% of my holdings. I've owned Amex since the 1960s. Let me tell you a story about that investment because it illustrates an important principle. In 1963, American Express got caught up in a scandal involving a subsidiary's salad oil business. The subsidiary had been providing warehouse receipts for salad oil that didn't exist, and when the fraud was discovered, Amex's stock collapsed. The question everyone was asking was whether this would permanently damage the American Express brand. I went out and did research. I visited restaurants and stores that accepted American Express cards. I asked travelers if they would still use American Express travelers' checks. And what I found was that the scandal hadn't touched the core brand at all. The card was still prestigious. The travelers' checks were still trusted. The business was fundamentally sound, even though the stock was trading as if the company was doomed. So I bought a lot, and I held. And decades later, it's been one of my best investments ever. What attracts me to American Express today is very similar to what attracted me 60 years ago. They have a powerful brand in the premium segment of payment cards. When someone pulls out an American Express Platinum or Centurion card, it signals something about their financial status. That brand value translates into pricing power. American Express also has a different business model from Visa or MasterCard. Amex is a closed-loop system. They issue the cards and they process the transactions. This means they take more credit risk, but they also capture more of the economics. They earn revenue from merchant fees, from card member fees, and from the interest on revolving balances. The flywheel they've built is powerful. They attract affluent customers with premium benefits and rewards. Those customers spend more, which generates more merchant fees. The merchant fees fund more rewards, which attract more premium customers. It's a virtuous cycle with high barriers to entry. American Express customers are also incredibly loyal and profitable. The average Amex customer spends multiples of what Visa or MasterCard customers spend. They're less price sensitive because they value the benefits and status. And the company has done an excellent job of expanding beyond the traditional charge card into credit cards, small business services, and travel services. I see American Express as a steady compounder that will grow earnings at a modest but reliable pace for decades to come. Coca-Cola is my fourth largest position at about 8% of the portfolio. I've owned Coke since 1988, and it's become almost synonymous with Berkshire Hathaway. People ask me all the time if I'm ever going to sell it. The answer is almost certainly no. Here's why. When I bought Coca-Cola, I paid about $1.3 billion for the stake. Today, just the annual dividends I receive from that position exceed my original investment. Think about that. Every year, Coca-Cola sends Berkshire more cash than I paid for the entire position nearly 4 decades ago, and the value of the position is now worth many times my cost basis. Why would I sell something like that? Even if the stock doesn't move at all from here, I'm earning a massive return on my original investment through dividends that grow every year. And I'd have to pay enormous capital gains taxes if I sold. But beyond the tax efficiency, I still believe in the business. Yes, soda consumption is declining in developed markets. Yes, health concerns about sugar are real. But Coca-Cola owns much more than just Coke. They own hundreds of brands, spanning juices, waters, teas, coffees, sports drinks, and energy drinks. They're adapting to changing consumer preferences while maintaining the most powerful beverage distribution system in the world. The Coca-Cola brand itself is estimated to be worth over $100 billion. That brand value is real. It translates into shelf space, into mind share, into pricing power. In most of the world, Coca-Cola is synonymous with soda. That kind of brand dominance doesn't disappear quickly. The business also generates enormous free cash flow with relatively low capital requirements. They've moved to an asset-light model where they focus on syrup production and marketing while bottling and distribution are handled by partners. This improves returns on capital and reduces operational complexity. Internationally, Coca-Cola still has substantial growth opportunities. As emerging markets grow wealthier, beverage consumption increases. Coke is positioned to capture that growth through its distribution reach and brand strength. I'm holding Coca-Cola forever, or as close to forever as makes any difference. My fifth position is Chevron, which represents about 6% of the portfolio. This is a more recent addition than some of my other holdings, but it fits my criteria for a wonderful business. Energy is a commodity business, which usually means terrible economics. But the major integrated oil companies are different. They have scale advantages in exploration, production, refining, and distribution. They have decades of reserves already discovered and valued on their balance sheets, and they generate enormous cash flow when energy prices are even moderately favorable. Chevron specifically appeals to me because of their discipline. During the shale boom of the 2010s, many energy companies overextended themselves, drilling aggressively and taking on debt to fund production growth. Chevron was more measured. They invested selectively, maintained a strong balance sheet, and focused on returns rather than production growth for its own sake. That discipline is paying off now. Chevron generates massive free cash flow that they're using to pay a substantial dividend, currently yielding around 3.5%, and to buy back shares. They're also investing in lower carbon energy sources, which provide some optionality for the energy transition. The world still needs oil and gas. Despite all the talk about renewable energy and electric vehicles, hydrocarbons will remain critical to the global economy for decades. We need oil for petrochemicals, plastics, aviation fuel, and countless other applications. We need natural gas for electricity generation, industrial processes, and heating. The demand might grow more slowly than in the past, but it's not disappearing. Chevron's valuation also seems reasonable to me. Energy stocks have been out of favor for years because of concerns about the energy transition and stranded assets. That's created opportunity for patient investors willing to look past short-term sentiment. I see Chevron as a stable, cash-generating machine that will deliver solid returns through dividends and buybacks while providing some inflation protection if energy prices rise. Occidental Petroleum is my sixth holding at about 5% of the portfolio. This one is a bit different from my other positions because of how the investment came about and how it's structured. I initially invested in Occidental through preferred shares when they needed capital to finance their acquisition of Anadarko Petroleum in 2019. The preferred shares paid me an 8% dividend and gave me warrants to buy common stock at a favorable price. It was the kind of deal I've done many times over the years, providing capital to a good company at an attractive rate when they need it most. What impressed me about the situation was Vicki Hollub, Occidental CEO. She was determined to make the Anadarko acquisition work and to pay down the debt they took on to finance it, and she delivered. Over the next several years, Occidental sold assets, generated strong cash flow from higher energy prices, and paid down debt aggressively. The company went from being over-levered and risky to having a solid balance sheet. I converted my preferred shares and warrants into common stock and kept buying more. What attracts me to Occidental is their asset quality and their focus on shareholder returns. They have premium acreage in the Permian Basin, which is the best oil field in America. They're also investing in carbon capture and sequestration, which could become valuable as carbon pricing becomes more widespread. Like Chevron, Occidental benefits from being a scale player in a commodity business. Their cost structure allows them to generate strong returns even at moderate oil prices. And management is committed to returning cash to shareholders through dividends and buybacks once debt reaches target levels. This is more of a value play than some of my other holdings. If energy prices remain favorable, Occidental should deliver strong returns. But even in a less favorable environment, the asset base is valuable and management is focused on the right things. My seventh position is Kraft Heinz at around 4% of the portfolio. I need to be honest with you, this one hasn't worked out as well as I'd hoped, but I'm holding it because the business still has value, and selling now would be locking in a disappointment. We created Kraft Heinz through a merger orchestrated with 3G Capital back in 2015. The idea was to combine two iconic food companies and use 3G's operational expertise to cut costs and improve margins. And on one level it worked. They cut billions in costs and margins expanded. But we underestimated how much the food industry was changing. Consumer preferences were shifting toward fresher, less processed foods. Brands that seemed invincible were losing shelf space to smaller, newer competitors. And the cost cutting, while necessary, may have gone too far in some areas, underinvesting in brands and innovation. The company has stabilized under new management. They're investing in brands again, expanding in faster growing categories, and trying to adapt to changing consumer preferences.
The portfolio includes truly iconic brands: Heinz Ketchup, Oscar Mayer, Philadelphia Cream Cheese, Maxwell House, and dozens more.
These brands still have value even if they're not growing like they used to. The stock is cheap on earnings and cash flow, and it pays a dividend of around 4%. I'm holding it because I think the business is worth more than the current market price, even if it takes years for that value to be realized. Sometimes in investing, you have to be patient with disappointments and work through problems rather than selling at the bottom. Moody's Corporation is my eighth holding at about 3%. This is a business I've owned off and on for many years, and I really like the economics. Moody's is one of the three major credit rating agencies, along with S&P and Fitch. When companies or governments want to issue bonds, they need ratings from these agencies to help investors assess credit risk. The rating agencies charge fees for these ratings. What makes this business attractive is the oligopoly structure. There are really only three players that matter, and the barriers to entry are enormous. You can't just start a new rating agency and expect to compete with Moody's or S&P. The agencies have decades of data, established methodologies, regulatory approvals, and most importantly, credibility with investors. Their ratings are embedded in countless regulations and investment mandates. This gives the rating agencies pricing power and stable revenue streams. When companies issue bonds, they pay for ratings, whether the market is good or bad. And while issuance volume fluctuates with interest rates and market conditions, over time it trends upward as the economy and debt markets grow. Moody's has also expanded beyond ratings into analytics and data services. They sell subscriptions to banks, asset managers, and corporations who need sophisticated tools for assessing credit risk and managing portfolios.
This analytics business is growing faster than ratings and has attractive recurring revenue characteristics. The company generates high margins and strong free cash flow with relatively low capital requirements.
They return cash to shareholders through dividends and buybacks. It's exactly the kind of capital-light, high-return business I like to own. U.S. Bancorp is my ninth position at about 2.5% of the portfolio. This is another bank, but it's quite different from Bank of America. U.S. Bank is the fifth largest commercial bank in America, with a strong presence in the Midwest and West. What distinguishes them is their focus on operational efficiency and risk management. They consistently rank among the best-run large banks in America. During the financial crisis, U.S. Bank was one of the few major banks that didn't need a government bailout. They had avoided the worst excesses of subprime lending and maintained strong capital ratios. That conservative approach to risk management has persisted under current leadership. The bank has a diversified business model spanning consumer banking, commercial banking, payments processing, and wealth management. They've invested heavily in technology and digital banking, which is reducing their cost structure and improving customer experience. What I like about U.S. Bank is their culture of discipline. They don't chase growth for growth's sake. They focus on profitable relationships and prudent underwriting. That might mean they grow more slowly than some competitors during boom times, but they also suffer less during downturns. The valuation is reasonable, usually trading at a modest premium to book value, which I think is justified by their superior returns on equity and consistent execution. The dividend is solid and growing, currently yielding around 4%. Bank of New York Mellon is my 10th holding at about 2% of the portfolio. BNY Mellon is different from traditional banks. They're primarily a custody bank and asset servicer rather than a lender. Here's what that means. When you own a mutual fund or pension fund, someone needs to hold those securities, process the trades, handle the corporate actions, and provide reporting. That's what BNY Mellon does. They're the backstage infrastructure of the financial system. This is a great business because it's based on long-term relationships and high switching costs. Once an asset manager or pension fund sets up their custody and servicing with BNY Mellon, they're unlikely to switch because the operational risk is too high. The relationship becomes sticky. BNY Mellon earns fees based on the value of assets under custody and administration. As markets rise and assets grow, their revenue grows too. They also earn some net interest income from securities lending and deposits, though that's less important than custody fees. The business is capital light with high returns on equity. They don't take significant credit risk because they're not really in the lending business. They're a toll collector on the flow of financial assets, which is a wonderful position to be in. Management has been working to improve efficiency through technology and to expand their servicing capabilities into alternative assets and new geographies. The stock trades at a reasonable valuation and pays a solid dividend. Kroger is my 11th position at around 1.5% of the portfolio. Kroger is America's largest pure grocery retailer, operating under multiple banners including Kroger, Ralph's, Fred Meyer, and others. Grocery is a tough business. It's low margin, highly competitive, and requires constant investment in stores and systems. But scale matters enormously. Kroger has the scale to negotiate with suppliers, to invest in private label products, to build distribution and logistics infrastructure, and to implement technology that smaller competitors can't afford. What's changed the grocery business is digital. Online ordering, home delivery, and pickup services are now essential rather than optional. Kroger has invested billions in building these capabilities, and they're seeing strong growth in digital sales. Kroger also has a valuable data asset. Through their loyalty programs, they have detailed information about what millions of customers buy. They're monetizing this data through a retail media business where consumer product companies pay to advertise to Kroger customers. This is a high-margin revenue stream that's growing rapidly. The company generates steady cash flow and returns it to shareholders through dividends and buybacks. The stock usually trades at a low multiple of earnings, which reflects the challenging nature of the grocery business, but also creates opportunity for patient investors. I see Kroger as a steady, durable business that will be here for decades to come. People need to eat, and grocery stores remain the most important channel for food shopping despite the growth of online alternatives. My 12th and final position is Liberty Media at about 1% of the portfolio. This one is a bit unusual and requires some explanation. Liberty Media is a holding company controlled by John Malone, who's one of the smartest capital allocators I've ever known. Liberty owns stakes in various media and entertainment assets structured across different tracking stocks. What attracts me to Liberty is the quality of the assets and the tax efficiency of how they're structured. Tracking stocks and complex corporate structures aren't for everyone, but when done right by capable people, they can create value for long-term shareholders. The key holdings include Formula One racing, Sirius XM satellite radio, and the Atlanta Braves baseball team. These are all businesses with loyal fan bases, recurring revenue characteristics, and difficult to replicate assets. John Malone has a long track record of creating shareholder value through creative deal structures, tax-efficient asset management, and patient capital allocation. I've known John for decades, and I trust his judgment on media assets. Liberty trades at a discount to the value of its underlying holdings, which is common for holding companies, but represents opportunity for investors who understand what they own. It's a small position for me, but one I'm comfortable holding because of the quality of the assets and the management. So there you have it, 12 positions. Together, they represent my entire equity portfolio, or at least the publicly traded portion. These aren't the only things Berkshire owns, of course. We own dozens of operating businesses outright, from insurance companies to railroads to utilities to manufacturers. But in terms of publicly traded stocks where we own a minority stake, this is the complete list. Now, let me tell you what all these positions have in common, because that's more important than the specific names. First, I understand every one of these businesses. I can explain what they do, how they make money, what their competitive advantages are, and what risks they face. If I can't explain a business simply, I don't invest in it. That's why you won't find me owning cryptocurrency or complex derivatives or businesses built on technologies I don't understand. Second, every one of these companies has a durable competitive advantage. That might be a powerful brand like Apple or Coca-Cola. It might be scale advantages like the banks or Kroger. It might be network effects and switching costs like American Express or BNY Mellon. But every business has some structural protection against competition. And third, I believe in the management teams. I've met most of these CEOs personally. I've watched how they allocate capital, how they treat shareholders, how they handle adversity. I need to trust that management will act rationally and in the interests of shareholders over the long term. Fourth, the valuations were reasonable when I bought. Notice I said reasonable, not cheap. I'm not looking for the absolute lowest price. I'm looking for wonderful businesses at fair prices. I'd much rather pay a fair price for a wonderful business than a wonderful price for a fair business, as I've said many times. Fifth, I intend to hold all of these for a very long time. My favorite holding period is forever. That doesn't mean I'll never sell, but it means I'm not looking at stock prices every day trying to trade in and out. I'm letting wonderful businesses compound value over decades. This approach isn't exciting. It doesn't involve artificial intelligence or quantum computing or whatever the hot theme of the moment might be. It's based on timeless principles that worked in 1950 and still work today. Let me share some thoughts about what I'm not owning, because that's just as important as what I am owning. I don't own any pure technology stocks besides Apple. And as I explained, I think of Apple as a consumer company. I don't own Google or Microsoft or Amazon or Meta or Netflix or Tesla. These are obviously successful companies, but I don't feel I have an edge in understanding their competitive dynamics or predicting their futures. Technology moves fast. Competitive advantages can erode quickly. The next disruption is always lurking. That doesn't mean these companies won't continue to succeed, but it does mean I can't predict their futures with the confidence I need to commit serious capital. I also don't own any Chinese stocks, even though China represents enormous growth opportunities. The regulatory environment is too unpredictable for my comfort. The accounting standards are different. The rule of law is less certain. I need to understand not just the business, but also the political and regulatory context, and I don't feel I have that understanding in China. I don't own any cryptocurrency or companies whose primary business is cryptocurrency. I've been very clear about this over the years. Bitcoin and other cryptocurrencies aren't productive assets. They don't produce anything. Their value depends entirely on the hope that someone else will pay more for them later. That's speculation, not investing. I don't own any special purpose acquisition companies or blank check companies or other financial engineering vehicles. These structures are designed to benefit the sponsors more than the investors. I have no interest in investing in something where the promoter's interests aren't aligned with mine. I don't own any meme stocks or companies with negative earnings trading on hype and narrative. The market gets caught up in stories sometimes, and stocks can trade far above any reasonable valuation based on hope and momentum. Eventually, reality asserts itself. I want no part of that. The point of telling you what I don't own is this: discipline matters. Knowing what not to do is just as important as knowing what to do. I've missed plenty of opportunities over the years by being too conservative or too slow. But I've also avoided plenty of disasters by staying within my circle of competence and refusing to chase trends I don't understand. Let me address a question I get asked frequently. How do I think about portfolio concentration versus diversification? As you can see, my portfolio is very concentrated, 12 positions, with the top 5 representing about 75% of the total. Many investment advisors would tell you this is too risky, that you should diversify across dozens or hundreds of stocks to reduce risk. I disagree with that approach. Diversification is protection against ignorance. If you don't really understand what you own, then yes, you should diversify widely. But if you really know what you're doing, if you've identified a few wonderful businesses that you understand deeply, then concentration makes sense. Think about it this way. If you have 5 great ideas and 5 mediocre ideas, why invest equally in all 10? Put more money in your best ideas and less in your mediocre ones. Or better yet, only invest in the great ideas and skip the mediocre ones entirely. The key is that concentration requires knowledge and conviction. You need to really understand what you own and be able to tolerate volatility without panicking. If Apple drops 20 or 30%, I'm not selling. I'm probably buying more if I have cash available. That's only possible because I understand the business well enough to separate temporary price fluctuations from permanent value impairment. For most people, especially those just starting out in investing, I recommend index funds. A simple S&P 500 index fund will give you exposure to America's largest companies at minimal cost. You'll get adequate diversification, and you'll match market returns, which is better than most active investors achieve. But if you're going to pick individual stocks, do it thoughtfully. Invest in businesses you understand. Look for durable competitive advantages. Buy at reasonable prices. And hold for the long term. Don't try to build a portfolio of 50 stocks unless you can honestly say you understand all 50 businesses deeply. Quality beats quantity. Now let me talk about what I'm looking for going forward. Even though I'm 95 years old, I'm still looking for new investment opportunities. Berkshire has over $100 billion in cash that we need to deploy productively. The problem is that everything is expensive. Stock market valuations are high by historical standards. Private equity multiples are astronomical. Good businesses are priced as if they're great businesses. Great businesses are priced as if they're perfect businesses. In this environment, I'm being patient. I'm waiting for better opportunities. That might mean a market correction that brings valuations down. It might mean a specific company stumbling and creating an opportunity to buy at attractive prices. It might mean a private company needing capital and willing to give us favorable terms. What I'm looking for hasn't changed. I want businesses with strong competitive positions, excellent management, good growth prospects, and reasonable valuations. I want businesses that will be more valuable in 10 years than they are today. And I want to pay prices that allow for a margin of safety if things don't work out quite as well as expected. I'm also thinking about succession. I won't be around forever, and I want to make sure Berkshire continues to be managed well after I'm gone. Greg Abel will take over as CEO when I'm no longer able to serve. He's been managing Berkshire's energy businesses for years and has done an excellent job. He understands the culture and the principles that have made Berkshire successful. The investment portfolio will be managed by Todd Combs and Ted Weschler, who have been working alongside me for over a decade now. They've proven themselves to be thoughtful investors who understand value and quality. They'll continue the approach I've established while bringing their own insights and perspectives. I think about legacy sometimes, not in terms of monuments or recognition, but in terms of passing along principles that have worked. The principles of value investing that Ben Graham taught me. The principles of focusing on business quality that I learned from Charlie Munger, the principles of patience and discipline and staying within your circle of competence, these principles aren't complicated. They're actually quite simple. But simple doesn't mean easy. The hard part isn't understanding what to do. The hard part is having the discipline to do it consistently over decades, especially when everyone around you is doing something different. When I look at this portfolio of 12 stocks, I see decades of discipline. I see patience through market cycles. I see the compounding of wonderful businesses over time. I see the power of doing a few things well rather than doing many things poorly. If I could leave you with one message, it would be this. Investing is not about being clever or predicting the future or timing the market. It's about finding wonderful businesses, buying them at reasonable prices, and holding them while they compound value over time. It's about being rational when others are emotional. It's about having patience when others are impatient. These 12 stocks represent my best thinking about where to allocate capital in 2026. They're not the only good investments in the world, and they might not be the best investments for your situation, but they represent businesses I understand, managed by people I trust, with competitive advantages that should endure. The portfolio will change over time as opportunities arise and circumstances change, but the principles won't change. And that's really what matters most.